My name is Michael Guyad, publisher of the Lead Lag Report. Joining me for the hour, Tommy Thornton. He's got a fantastic following, fantastic research as well. Tommy, for those who are not familiar with who you are, your work, just set the stage for the audience as far as your background, your analytical skill set, and what you do with hedge fund telemetry.
Okay, well, thank you, Michael, for having me on again. And good afternoon to everyone. I hope everybody's having a very nice weekend. The markets are closed, so we can all relax and enjoy what's really most important, which is basically the weekends with family, with friends, looking past some of the carnage of what's been happening in the last, this year. My background, I live in Greenwich, Connecticut. I am formerly I was a senior trader and a portfolio manager at a hedge fund. It was a $5 billion hedge fund. Had a great run until it ended, which that's a whole nother fun story that I'm not going to get into. I left the fund and did a couple other things. I ran a family office for the founder of our fund. I helped raise $50 million for Alibaba when it was a pre-IPO position. It worked pretty well, as you can imagine. And I had the idea back in 2012 of putting out my research that I did through internally at our old fund. And I'm a technical analyst. I am a sentiment specialist because at my past firm, I was tasked with talking to all the different sentiment poll people, from Ned Davis to the Market Vein to Daily Sentiment Index with Jake Bernstein. And I became very familiar with all of that. And I figured, it'd be cool to put it out to a select amount of people. I had some hedge fund friends, and I started doing that. And then it became a thing. And it started in, I think it was 2016. I started putting it out to about 25 pretty well-known managers. They've varied from mutual funds to hedge funds to, I even had some pension managers. And I was having a good time doing it. The main thing is I really enjoy doing the research. I find it to be such a challenge to find ideas, to find themes, to see overbought and oversold type conditions in markets, in different markets. My main focus is US equities, but I do have a macro focus, and I look top down at, bonds, currencies, commodities, and I look at how everything comes together. I try to pull it together. And what happened in 2017 is I put out on Twitter, one of my old traders, Keith, fantastic financials trader, he said, dude, you should just put this out there on Twitter because it's really good and you might get people that would be interested. So I did that. And within like 2 days, I had 3,000 people that DM'd me. And I hit my friend that helped me with a website for another business. And I said, look, I got a problem here. And he said, okay, I'm going to solve it. So we just started building this thing. I had no idea where it was going to go. Now I have a pretty good following, a great business. I put out 3 notes a day. The first one is just basically I get summaries from Street Account, from Vital Intelligence, Bloomberg. I basically get everybody up to speed what's happening pre-market. I show pre-market quotes and other good stuff, charts of different things. I then put out a mid-morning note at 10:30, and then a little later, I put out a daily note that has a little bit more narrative and more good stuff. I do specialize with DeMark Analytics. I've been a user of DeMark indicators since 2000. That's correct. And I have found them to be very useful for my trading. And my trading can vary from sometimes short term to intermediate term. I don't really have a good edge on long term, which I don't think many people do at this point. So that's what I do. And I come in every day trying to bang it out and keep things moving in the positive direction.
All right, so you use the word carnage, which I think is a very appropriate term in the sense that, uh, and I've been banging this for a while here. This idea that this has been a hellish year, and in many ways worse, I would argue, than 2020 and 2008, in the sense that you don't have sort of these classic inverse correlations kicking in, except maybe recently with treasuries when equities get volatile, right? And that's been a lot of the hell that I keep referencing on Twitter and in my own media appearances, that proven historical notion that treasuries tend to act as the counter asset when equities get volatile and you have a correction. So you had this horrendous carnage in the bond market, and a lot of carnage underneath the surface for stocks really going back to February of last year. Now, I saw a tweet that you put out. You said signs of capitulation. And the term capitulation is an interesting one because that would suggest, obviously, that people are surrendering, and that's the low, right? It's the abject fear. Um, Talk about if you think we're really at that point. What are signs of sort of traditional capitulation, and why might we be at or maybe not at that point now?
Well, when I put that tweet out, it was early yesterday morning, and that's been the big thing. We have a lot of stuff that the technical stuff that I look at, a lot of internal indicators that have been on the flat line for quite a while. It's very simple to look at the percentage of stocks above the 50-day moving average or the 20-day moving average, and they've been just dreadful, especially in the NASDAQ composite. It's just been horrendous. And it's been bad even when we were at all-time highs, because you had the mega cap stocks, holding up the indices. And now you've seen most of them, fall apart. And that's usually what happens towards the lows of in the markets. Yeah, the equity market really, let's go back a bit. The equity market went up way, way too much. And the equity market had leadership coming from some really garbagey type companies that went up. I mean, you had Carvana near 400 and it's $33 now. You had these meme stocks going ballistic, and they've all come back down to earth, and reality set in. Tesla is basically half off of where it was at the highs. It's a big market cap loss as well. In a bear market, a true bear market, there's no place to hide. There's no easy place to hide. You can hide in cash, obviously. That's the easiest and simplest and safest place. You don't get any return when there's inflation. The bond market, when the bond market goes into a bear market, and that's something we haven't seen. Well, the bond market's in a bear market, and we haven't seen that in our careers. I remember I was in 1994, the bond market fell apart, and it was sort of a mini bear market. But this is something entirely different, especially with the amount of capital that's in the credit markets, the sovereign debt markets. It's just it's unbelievable, the amount of carnage that we've seen. The other thing that's been, in my opinion, the most reckless central bank policy was the negative interest rate policies in Asia and in Europe. And to think that we had at one point well, there was not us, but there was $18 trillion worth of negative interest yielding debt in the world, and now we're at 2.6 trillion. That is just obscene. How much, when you think of the carnage of people that have fund managers that bought negative interest yielding debt. And I had a conversation with the head of Blackstone's global allocation years ago. And I said, why are your managers allocating money towards negative yielding debt? He said, because they see the prices continuing to go even lower. And that to me was just a sign of this is flat out crazy, because now those holders, and there's a lot, and especially in Europe and, well, Asia too, but they are now holding debt at a negative carry, and they're paying the coupons. That is just, to me, the ultimate in the worst policy ever. So we have a lot of stuff that's happening. It's not over. This is not a bear market that's going to be a 2-quarter bear market. This is going to be a longer term bear market. And I hate to say that because it sounds like, oh, well, you can't make any money. But I absolutely love this type of market. I love volatility. I love catching bounces because one of the things that's nice for me is I have my market sentiment stuff go up to the, they were the highs and now it's at the lows and you get these bounces. And the DeMark indicators have been absolutely fabulous because at the highs at the end of the year, all I had was sell signals and everybody thought I was a complete idiot. Like, what the hell are you thinking? Uh, but as you see, that's what happened. And now we have the opposite. Bullish sentiment on the S&P hit 9% bulls on the daily sentiment index recently. It bounced off that level. I think it was a week ago. I was set up pretty long. I thought we were going to have about maybe 10-day, maybe 2-week, a 2-week type move. It lasted 4 days, and that was it. I had to pivot real quick and say, oh God, target. The market hates this type of stuff, and I knew they were going to punish the market. I got out of a lot of stuff, captured some profits, less profits than I hoped. But we're in this type of environment, and I've said it, I think when we first spoke earlier in the year, it's a tactical market. It's not one for anybody to get long conviction in anything. And I'm just banging around things that, and the other thing is I'm trying to trade higher quality in this environment. And I recommend people, if you're looking to add longer term positions, add top quality, upgrade your portfolio. You can get a bigger run in something that is more speculative. But I was buying Amazon recently. I bought Target on Friday. I feel like some of this stuff is washed out, and of course it could, if it goes lower, I'll stop myself out. But it is a tactical market. You can profit in tactical markets. Now, the weird thing is, and I was looking at my stats for this year, I've traded 255 trades this year, and I've had 100 short ideas and 155 long ideas. Now, it's a bear market, and I have notably more longs than shorts, and that was different from last year. So I don't know what I'm thinking, but I'm just finding more long ideas that are tradable opportunities. It's hard to short down here, and I think it's foolish to be trying to press at these levels, especially with short interest is rising. You have extreme put buying that I'm noticing. I mean, those are some of the capitulation type things I've seen. High put buying, and the people on CNBC will tell you, we're seeing the smart money buying calls, or the smart money's buying puts. I mean, you don't do that. That's not the smart money. You fade those people, and that over and over is the right way to trade the market. So I use a lot of different non-correlated type of indicators, and I add it up. And one thing I've said to people about hedge funds, it's like sausage making. You really don't want to see how it's made. You like the taste of it, but you don't want to see how it's made. And you like the performance of a hedge fund, the one that hedges and performs, but you don't want to necessarily see how it's made. You'll make a lot of mistakes in this type of market, and I'm very cognizant of making mistakes. I'll sell too early. I'll buy something, I'll have to stop out, or I'll short something, I'll have to stop out. It's just about managing risk.
Yeah, and by the way, on that point, that may be also why treasuries might be a better way of betting against the market now, aside from the fact that 2 weeks ago, the risk on, risk off behavior seemed to kind of come back after this unrelenting correlation between rising yields and stock market volatility. But and that's a key part of what I do and a lot of the research I put out there, that usually if you want to bet against the market, it's less about making a short bet because there's false signals there. But treasuries tend to be sort of your better way of playing a bearish view in equities, because at least treasuries allow you to be wrong and still make money. Obviously not this year, right? But at least so far.
So first of all, I was seeing like I thought we were going to get a bit deeper on a few of the indicators that I look at. And I had a few of my friends Andrew Thrasher, who I think does fantastic work. He's a great technician. He said, "I'm not seeing the signs," and it wasn't enough. But I started to think that, and I started talking to some. I was talking to some sell side uh, institutional traders, and they were like, "Yeah, we're starting to see some people getting a little nervous here and panicky." And that was one thing. I like to see real high. The put call ratio go up pretty high. And I use like a 5-day moving average or 7-day moving average of the equity put call ratio, and it's getting up there. It's not at the peak where we were in 2020, or 2018 at the lows, but it's at levels where historically it gets toppy. I also thought maybe we won't have a true capitulation like the shorter term type moves, like March of 2020 or December of 18. Those were really solid uptrend, V bottom type things, with one quarter. So I think that we also have another dynamic, is that you're starting to see margins compress, and you're seeing that due to inflation, due to the tons of different labor costs, the input costs of materials, the shipping costs. Everything is really starting to hit earnings, and the market sort of woke up like, whoa, Target, hi, what happened there? But I think as far as a longer term bear market, I think we just haven't seen some of maybe we just won't see improvement. Now, maybe the Fed hasn't started QT. We don't know the effects of how that's going to be. That starts in a week. I think the market, though, will start to get used to bad news, or get used to the thought of 50 basis points hike, and any sort of deviation from that. I forget which Fed had said, maybe later, I think it was Evans said, maybe after 250s, we're going to start to go at 25. The market will probably like that and think, okay, they're moderating. I think the big mistake the Fed did was they overdid it in 2020. We can all agree on that. And then the second was that they should have started earlier, smaller, and just started to take their. They should have started the QE ending and tapering a lot earlier, and even started with 25 basis points. If the market can't take, the Fed funds rate at 25 basis points and freaks out about that, I think we've got much deeper problems than that. Yeah, that's been a real. A lot of people are watching that and hoping for some sort of VIX spike. And the other thing is, everything's been very orderly. This hasn't been a pullback of like panic. It's just been very orderly. Everybody said that to me. Every sell side person is saying, yeah, it's very orderly. It doesn't seem as bad as if you look at the screen and your screen's all red. And I think maybe there's there's some dynamic.
But hold on, there's a distinction there, right? Because it's been orderly in the large cap, passive averages, but again, beneath the surface, there's been some unbelievable devastation, as I know you've talked about too.
Yeah, but even when you have Roblox down 8%, or Dollar General down, was it 7% on Friday? Nobody was really. They're not really panicking. I mean, I don't. And I don't watch CNBC, so I don't know if they're pulling the markets in turmoil yet, or I know they did once. But it seems very orderly. I think the target was a panic. I think that was a real shocker to the market. That how could Walmart and Target, these fairly safe places, get absolutely hammered? I mean, Deere. Where was Deere? Down some 15%. I mean, that's just unreal to see something like that. But I think that's positioning as well. I think people are still positioned long in a lot of different things, and they're getting surprised at the magnitude of the misses. And that actually was very similar to the beginning of the end in 2000. And we had already some market slam already in the spring, and then we've had some bounces, and then in the third quarter, the tech names started to miss. I remember distinctly, I was working for a hedge fund in Los Angeles, and Nortel blew up. The Nortel Networks, which was the largest Canadian company at the time, it was like a Cisco, and that was like a shocker. And it really, it was like, oh my God, tech is going to blow up. And they were a big buyer of chips. And I remember sitting in a investment committee meeting, and nobody was really panicking at the time. What should we do with AMCC, a semiconductor that sold to Nortel? I don't know. I think we should just hold on and just wait it out. I mean, it went from like $90 to $5. That's what happened, through the bear market. So I think we may be historically in a place like that third quarter starting. And there were bounces. There were huge bounces in 2000. And a lot of people have shown the charts of previous bear markets where you have these, 10 spikes going down. The markets go down 75%, but you have like 10 spikes of 10% or more along the way. And I think that's the pattern that we're in right now. So I agree that we're not there with all the things lining up for a capitulation. And maybe we'll get that capitulation in a quarter or from now. I mean, there's still a lot of people that want to buy stocks. And that's the thing. There's still a lot of capital coming into the market. You see these incredible inflows into ARK. I mean, I've had a lot of people say, "Well, when should we buy ARK?" What do you mean? When should we buy ARK? This is a fund under pressure. They're buying companies that don't make money. That's not where you want to bottom fish. You want to bottom fish in good companies. You want to buy the Amazons that are down significantly, and that their business is going to be there. I mean, that's the thing. You've got to be cognizant that if you're going to buy anything, buy good quality. And some that have already blown up. I mean, I'm long Apple. I'm not really thrilled about it. I was short and I bought it, thinking that we were going to get this bounce, but I can live with that. I'm not going to panic over, oh my God, I can't believe I bought Apple. I'm not down that much. I bought Nvidia. I was short all these things from the highs, but now I know what people are going to buy when the market does bounce. The problem, if a multi-strat fund manager or a mutual fund, they see the roof collapsing on bonds or equities, they have to find liquidity to sell other things too. They don't just, we're going to move all of our money into gold or things like that. They'll sell anything that's not nailed down. And that's been why you see the Bitcoin getting hit. You see gold well off the highs. Energy's been exceptionally strong, and that's partly due to a lot of geopolitical issues, supply issues. That's been a good place to be. I don't think we want to start allocating money towards those places right now. In a bear market, it's a bear market. You can't hide. Cash is great. You can sit tight in cash, and you may not get a return, but you're not going to lose anything.
Correct. You're not going to lose anything, but of course, we all know you lose after inflation. I always have this kind of back and forth around cash as whether it's a residual or it should be treated as an investment, right? Because cash obviously doesn't allow you to have a chance at momentum, which we can talk about too.
One thing that happens on Fridays, especially on expiration, every Friday is an expiration now, but on the third week expiration, you see a lot of VIX selling, and those are dealers that are, let's say, changing their position going into the weekend. And I used to remember, we used to call it, Janet Yellen, when she was the Fed chairman, had the joystick and would just pound the VIX on Fridays, and that would lift the market higher. So that was just, I think, a positioning move. I think there's also a lot of people that they see green or they see something moving and they're going to pile on as well. And that's been the way the market was in the last couple of years. We've seen, whatever, newbie trader, you see that couple that were on TikTok and they said, here's our strategy. We buy things that are go up, and then when it starts to crest, we sell it. And so anybody buying green that's what people do. And everybody's trying to catch a bottom. It's not as much as trying to catch a bottom as it used to be, but still, I think there's that action happening. And I do think it was just dealer positioning. You had a lot of people that were out there saying that, the bottom was going to drop out on expiration and it's going to be awful on Monday. It's hard to really make those predictions and especially dire predictions like that at lows. I think this was just a matter of VIX positioning and dealers setting up for the next week, and that's basically it. I mean, don't get me wrong. I'm set up long, and I was buying stuff into that. The market was going up, so I have no complaints. And by the way, thank you for being a subscriber. I don't know who you are, but you can send me an email, and I will send you a very thank you personally. So cool.
Can we talk about sentiment for a moment, Tommy? So you mentioned some numbers on sentiment, and I don't know, it seems to me that sentiment is actually really hard to get a gauge of nowadays, because if you use Twitter as your gauge for sentiment, we know the algorithm is going to throw things at you that may not be a true reflection of the quote-unquote crowd. So talk about how you look at sentiment. What are the measures that are more objective? And from your experience, at what point does sentiment really kind of tell you? I mean, obviously it's extremes, but how extreme does sentiment needs to get to suggest a turning point?
Well, one thing I always tell people is sentiment is a condition. It's not necessarily a trigger. And in dark bear markets, market sentiment can stay low for a longer period of time. And the opposite, it also can stay elevated for an extended period of time in a bull market. So you can get to these extremes. And my favorite I use, and we have charts on our site with the daily sentiment index. And basically you can see when something gets to 90% bulls, that's an extreme level. And it's not necessarily where you want to just say, oh, I'm going to short the market, but you wait for some sort of trigger reversal, and then you actually follow it down. Now, daily sentiment index, created by Jake Bernstein, he pulls average traders, not he's not calling Paul Tudor Jones and saying, are you bullish or bearish? But he's calling just the average person, are you bullish or bearish on a bunch of different markets, from stocks, bonds, currencies, commodities. And from there, he gets percentage of if you're bullish or bearish. Now, the dumb investor, and I don't like to call people dumb, but that's what he does, is not necessarily always wrong. But I like to see when the trend changes. So I run a 20-day moving average of actually the sentiment. And the 20-day moving average of the S&P is at 19 right now. And the S&P on the daily sentiment index is at 15. Now, it was a little lower, and that last spike last week raised it up towards 20. That's a very low level. But what I'd like to see is the 20-day moving average of bullish sentiment start to decline. And that would tell me that we have the potential for a trend change. Now, one thing that I will say, the dollar has been pegged in the extreme zone for a long period of time, and that's above 80%. Now it's at 74% today or yesterday. And the 20-day moving average of the bullish sentiment on the dollar was at 90%. That's the highest I've ever seen it. And it's starting to float down a little. It's at 86%. So I'm thinking that the dollar has some potential to turn lower, and that's it's something I'm watching. I'm long euro, I'm long sterling. But the other one that everybody can look at, and I think it's really a good one, and it's the CNN Fear and Greed Index, because everybody can tell you, oh, I'm bullish or bearish, but it's actually, they compile this from what actual traders are doing. and they have 7 different inputs. And I look at this every day. I think it's a good one, especially real time intraday. It hit 8% yesterday at the lows, and it closed at 11%. That's very low for this as well. I don't look at the AAII sentiment poll, partly because they ask traders, they poll traders and say, are you bullish, bearish, or neutral? I think neutral's a way of people avoiding the answer or making a call. And so I don't really like that poll. A lot of people look at it. That one, and I just don't find it as useful. I mean, it went very bearish very early this year, and it just hasn't been, it's not useful for me. I like Ned Davis's work, one of my heroes, and those guys do excellent work. The Ned Davis Crowd Sentiment Poll, which is one of the older ones, compiles the Investors Intelligence, the Daily Sentiment Index, some other things. And I actually was out with, this years ago, with one of the analysts at Ned Davis. And I'm like, come on, you got to tell me, what's the secret sauce? And he basically said the Daily Sentiment Index is their favorite. And it's a daily poll. It works. I try to smooth it with a 20-day moving average. It works pretty well. But sentiment right now, you can also look. I always tell people, look at the Drudge Report. The Drudge Report is incredible. They find things when things go on that, that that's where the noise is. The crowd is going towards that. So that's something, just a little anecdotal thing. Well, it's a good thing that you have an advisor. I'm a big fan of people that have advisors, partly because it protects you from doing dumb things. A lot of times the capitulation time is when people will just puke their things and they're not thinking rationally. And an advisor will help you balance your portfolio based on your time frames and risk tolerances. So I think that's one of the main things that I stress. It's a hard thing to say. Do you want to bail out of things and rebalance? I think you should always be thinking of rebalancing and not doing necessarily big grand changes. But at times like this, I think it's important to say, I want good, high quality in my portfolio. You want to own what will be fine. Amazon's not going down 93% like they did when they in 2000. That's for sure. It's just a great company. They're going through a difficult time, with a lot of different problems with inflation, with the consumer potentially slowing here. But you've got a pretty good price at these levels here, and what makes them money is Amazon Web Services, and I do believe that will be a sustainable business that will continue to do well. But right now, I think we're still early on with the bear market, but I would always be upgrading to higher quality. And the other thing is, and Michael will probably appreciate this, you actually, in fixed income land, you can actually find things with a yield now. Bond investors, it was the joke a couple of years ago, they were buying bonds for the capital appreciation, and they were, investors were buying stocks for the yield. And there's a lot of good yielding equities out there as well. So I think that, especially with things that have moved down. So I think that you should always be rethinking, rebalancing your portfolio, but always with, top-notch, good quality. I look at all the factor analysis through Goldman, and it's absolutely been one of the more difficult places to look for. I mean, the S&P growth is down year to date 26%. The Russell value is down 13%. I mean, there's nothing up. So that's the S&P value is down 8%. That has a lot of energy in there as well. Year over year, I have mine up 2.3%. So there's a winner there. I mean, leveraged beta basket is down 12.5%, but only down 6% year over year. So look, I think high quality, just going back to high quality, the high quality baskets are flat year over year. And that's my factors. So I think that, again, high quality is always going to be something you can sleep at night with. You could still have some downside, but you're going to most likely get stocks that have, dividends. And as the markets start to recover and life gets a little bit better economically, you can then rebalance into perhaps some more aggressive things. But right now, I think it's important, Jeremy. Just like you said, quarterly rebalancing. It doesn't have to be every exact, April 1st or January 1st. You do it. You can go in between the quarters and start to look at the longer term picture and what's working, where things are starting to improve month over month. That's one thing I do a lot. I look at, short term, I look at 5-day rolling, and I also look at the 1 month rolling on all my indices and all my factors. And you want to start to see that improve. That's something that I think is really important. That's where I see things moving. And you probably look at things, Jeremy, a little longer term, but those are I always look at 1 month because that's an important rate of change for me. Well, it's funny you say biotech, because I started buying biotech in the last couple weeks. Actually, the last 10 days, I started buying IBB and XBI. This is actually one of the earlier sectors that started to fall apart and continue to fall apart. It actually was up in the last. It's been up. It was up on Friday, half of a percent, and it was up on the last 5 rolling days. And I think you're probably going to start to see it up. It's down 8% for the last rolling month, but it's off its highs or lows, and we have DeMarc buy countdowns on the absolute dead low. And it the thing that I did read, that there's a majority of biotech companies that are trading under cash, and that, well, right there, that sort of sparks my interest right there. But this is, if you want high tech, I think biotech is high tech, and something that has been out of favor and could come back and improve. So I would allocate some towards biotech, the IBB and XBI, and these have been. I'm looking at. I'm gonna give you the percentage on IBB. Is down 34% since last September. So that to me is okay. That's a index down that much. That's pretty substantial, and there is growth in biotech, and so that's something I'm looking at. As far as the EV sector, the problem I have. I mean, first of all, I'm not a fan of Tesla. I think Tesla's still one of the best shorts in the market. It's not easy. Don't put too much into it, and be nimble on this. But there's a lot. It's a Wild West type market, and you still have. I've seen the Lucid. I saw one drive around the other day. I saw a Rivian drive just as I was walking to my office today. Yeah, they're great. There's a lot of potential there, but I still think it's the Wild West. And remember back in the day when the internet stocks in the late 90s ran up to just unbelievable multiples, and many of them didn't make money and many of them didn't succeed. This is a worse period for speculation because the market caps of some of these stocks that are, that have gone down substantially are still at levels that don't make any sense to me. And look, I'm a big car fan, and I love the whole idea of EVs. And I think that I was looking at what is Lucid right now? Lucid's market cap is 30 billion, and I think Ford and GM are 50 billion. And I just think that it's still, these are companies that are still way, way, underwater. They don't make money. They barely can get their cars out. There's a supply chain shortage. It's not my thought that it's still it's a good place to be at these levels. I think this whole group can go lower. And the same way, like I said, Amazon went down 93% from its high after going up 6,300%. Sounds a little like Tesla. And Tesla still has a $650 billion market cap, which is, I think it's still, I mean, again, Ford and GM, $100 billion market cap together. There's great technology out there. There's a lot of new competition coming on. I think you just have to see where things play out. I mean, Rivian is a $26 billion market cap. That just makes no sense to me. And they're losing $24 a share, and it's a $28 stock. So I just think that it's still the Wild West in this group, and there's probably better places to go.
And let's turn that into a question for Tommy. So Tommy, given that sort of backdrop, and I've seen that too, how would you yourself screen for some of those, sort of hidden gems that are not often in the media or often referenced from a stock picking perspective?
Right. Thanks.
What would be your approach, Tom?
Well, thanks. You made some very good points, and I agree on everything you said as far as the bottom will probably not happen for a while. And that's I agree 100% on what you're saying. I know Amazon is not cheap. It's never been cheap, but it's what people are going to buy. And it's I hear what you're saying. The point is, I'm a trader. I'm looking for, if you're going to if you're long the Qs, you better be long Amazon. And because Amazon's going up more than, it's a top 5 market weight. And that's how I'm looking at it. I know I'm not necessarily looking for value.
Yeah. But I don't want to go too down the rabbit hole on this, but I think, and Tommy, you can speak to this. I think it's ultimately about time frame, right? So maybe let's pivot that for the remaining 5 minutes or so as we wrap this up. Talk about the different time frames with which you analyze individual stocks and how you merge that with sort of a macro mindset. Because I think you can be both bullish and bearish at the same time. It just depends on how long you're looking at it, right?
That's true. That's true. Right. Yeah. You have. I don't disagree with anything you're saying. I totally get it. I'm just looking for especially in this passive trade, passive market that we have. People are, and you're right. Everybody knows, and they're waiting for a bounce, and everybody's expecting that. And it's when they don't, and everybody hates it. They hates the market. Don't get me involved in the market. I'm firing my broker. Blah blah blah. That's a bottom. But if the market's going to bounce, it's going to bounce with the top 5 names doing the work again, and they. Yep. So I'll be fine, and this would be a completely different conversation of 6 months ago when Amazon was at 3,500, because that made absolutely no sense to me. And I remember being on I think it was a Spaces, and someone was saying, do you like Amazon or Shopify? And I said, I think both of them are going to get crushed. And it just was like, they were like quiet, but at these levels, it's a lot easier for them to bounce at these levels. Right. My view is that I try to trade for, weeks. Sometimes it's a little shorter term if I get lucky on something. But I trade for weeks. And just one thing, just as I've done a lot of custom indexes, and I have one called the MAGA index. It's Microsoft, Apple, Google, and Amazon. And this topped on the 19th of November last year. Had a DeMarc combo at that level, and it's down 35% from that high. That's a pretty deep pullback for these pretty substantial companies. In 2020, the quality, these types of names also pulled back about 35%. So this is a pretty deep pullback, and everybody can say, well, the S&P is only down 20%. It's a bear market. Sometimes when you hear that, you get the red Bloomberg headline says, the S&P enters a bear market. That's almost like a buy, in my opinion, because now it's like, oh, great. Actually, a good question. I trade put spreads a lot, and I recommend put spreads as a smart way to hedge or for a directional bet. This is a market that we've seen these bounces, and they've been somewhere around 2 weeks that move, and so I've been trading. I had the last put spread I did on the Qs. I was on Bloomberg and I talked about it. Usually when I go on Bloomberg, I have something that completely fails, but this one worked for the Qs. I usually go 1 month out. That's it. I don't like to go 2 months out. I feel like I'm paying too much in premium. So I'll go 1 month out. I try to look at the first strike, at, say maybe 2 to 3% lower. And then, then I look for some sort of, if there's a moving average or some other support level below, but I try to get 3 to 4x on the put spread from the lower strike. And that's generally how I look at it. And I shouldn't say never, but I rarely will hold a put spread through the lower strike. It's happened, and that's great, but I usually will tell people take some off as you go. And I'm not, I never get greedy on any type of option trade at all. I monetize, because especially in this type of market, you could have a like you saw Friday. I had some options, I had puts on for next week on the S&P and NASDAQ, and those just basically evaporated with the last hour's action. So monetize the put spreads. I like 1 month out, especially in this type of environment. You certainly can. You'll know if you're right and you'll know if you're wrong pretty quickly. But you don't need to go 2 months out. I think that's too far. I mean, if that's your, it makes you more comfortable, then that's fine. But I've just found 1 month to be acceptable.
I think that's a good place to wrap up. Again, everybody here, make sure you follow Tommy Thornton. Make sure you also follow Jeremy Schwartz, do a number of spaces with him and his team. I am going to have this again as an edited YouTube video, probably in a couple of weeks here. Tommy, I always appreciate your knowledge, your time, and everybody enjoy the rest of your day. Thank you, everybody. Thank you, Tommy.